everyone for joining us and joining our webinar on the evolving trends in today's market. I've got a great panel, which I'm going to introduce, and it's certainly an interesting time in the world and in the market. Rates were lowered yesterday, as all you guys know. And while this was expected, it is certainly a welcome change in the market, as you can see in the overall stock market and in how rates are responding as well. So lots to talk about, lots of interesting trends. With that, I want to introduce our first guest, Robert Senko with ACC, president of ACC. Thank you, Robert. Robert has been a longtime customer of LoanNEX and has been a long-time participant in the industry. You sent over your bio, and I have to say, so I have to read part of this. You started, I'm going to say, in the early 90s and sold your first company in 97. And then you've spent your entire career in B&C, subprime, non-prime, non-traditional, non-QM. How many more labels have we got for this part of the market? But anyway, thank you for joining us.
We've got to come up with some new names going forward. Like, you gave your titles, should be the legendary Eloise, CEO and co-founder. No, thank you for having me. You guys have been a great long-time partner, and it's been a while since I've done one of these with you. It's been a while since I've done any of these. So this is kind of fun and great to connect with you and meet a new friend in Clint, who's going to be joining us today.
Yes, thank you. Clint, VP Correspondent Lending with Silverhill. Clint Thomas, thank you for joining us. He too has been a long customer of LoanNEX's, and he brings over 20 years experience in the mortgage industry. He is currently heading the non-agency business development efforts at Silverhill, and they are definitely focused on driving growth and strategic opportunities. And I appreciate you're going to bring all kinds of interesting insights into the panel as well. So thank you for joining us.
Thanks for having me. Excited to see Robert again and you, Eloise, and talk about all the exciting things we have going on in the market.
Yes. And from the LoanNEX side, Robert Trahan is our SVP of Sales and Support. He's been with us for about, 7 or 8 months now. Time flies. And he's like an old LoanNEX veteran now, but he spent, the better part of 20, 30 years in the industry as well, and has a great line of experience with the other side of the desk, or with our clients before joining LoanNEX. So we're very excited to have you with LoanNEX and on the panel.
Thank you very much, Eloise. Glad to be a part of it.
So I'm going to assume everybody can see my screen. I don't know. Give me a nod if it's up there. I hope.
Yep.
Okay. I just did all of our introductions. I'm going to just sort of start with some comments on what's going on in the market. I can't wait to see how this is going to adjust in September. So we'll get that in probably a couple of days. But in August, there was sort of a continued, little bit of a suppression of projections and expectations for origination forecasts over 2025 and in the out years. So the little purple line is showing where it was in May, and then you can see where it is otherwise. I'd love to get your thoughts on sort of, we're seeing, what I love to see in this is the dark blue. That's the purchase market. It's pretty much flat this year, but growing in the out years. But it's never been declining. It's been, sort of on a steady state coming up. It's the refi activity that really, changes the volume overall each year. But with rates coming down, do you see that having an opportunity to actually expand the purchase market? Do you think that it is still, a little bit of inventory deprived? Or I'll let you kick that off, Clint. Where do you see the market going?
Yeah, that's a great question. If I was certain of the answer, I certainly wouldn't be doing this. But I tell you, it does feel like, at least just in the last few weeks, just going off of some personal experiences, houses that have been sitting for a little while have started to move, go under contract, and it does feel like a little bit of a rate pullback in terms of a rate reduction could potentially get some more buyers off the sidelines and back into the market. So I think that's pretty exciting to see.
Hey, Robert, do you have any insights?
Yeah, I'm not that smart. I went to the University of Maryland when it was easy to get into. So it's a, there's still an inventory challenge in the market. That being said, people are moving, life changes, and even with that, the chart that you see there, you see the purchase activity continue to grow. So you've got to have that as, your core business. You gave a nice introduction. Myself, I still view myself as a glorified loan officer. So, speaking to the folks that are out there, the originators that are trying to gain insight, not our competitors that I saw on the pre-list. We don't want them listening to our brilliance, Clint, but to the originators, what they could garner is, using non-QM and all the products that we're going to talk about and some of the insight to make themselves better going out there to the marketplace, to their agents, to referral sources, and being able to kind of touch all these. And that's really what's exciting about non-QM is it opens up your toolbox and being able to service more clients for the originators out there. So that's what I hope to drive home for a few of the folks out there that are still learning and trying to understand, although we know the growth of non-QM over the years, there's been more of an adoption of the product in the marketplace.
Yeah, and you're teeing me up perfectly for the right side of the page. Over here at LoanNEX, when we started this company and we launched our services back in 2016, and if you paid attention to that little blue line, that's what we were trying to do, is make that little blue line look like more like the left side of the chart over there. And we really started LoanNEX with the vision of there is a place in the market, a very important place in the market for products that are outside of the agency products. There is great demand, both from depositories or portfolio holders, as well as the securitization market. And we, started and founded LoanNEX was really the whole idea of being able to provide a platform for investors that have whatever they have as their credit guidelines or their attributes to be easily communicated to an originator so they can originate it. And both sides have transparency, alignment, trust, all of those kinds of things. We were a little early, but what we're seeing now, and this is really important, I think, that I'd love to get your thoughts on, is we're seeing this rotation happen. Some of this is been dependent upon, some of the environmental or regulatory parts of the market, which we went through a little squash on that side and then the rates came down, and that's not very interesting for the markets to invest in. So that didn't create an enormous amount of demand from the institutional side of the market. Now you're seeing rates at a place where it is very interesting. So we're seeing a lot of new entrants. You're seeing this rotation happen where depositories are actually not the primary portfolio holders, but more institutional investors. And you're seeing a lot more liquidity in the securitization market. And that is bringing, a little deeper balance of the non-agency market into the total market. And that's where we believe there is going to be continued opportunity for serving a broader market in order to provide access. There's strong liquidity. This is not a market that's trying to target poor credit. This is a market that's trying to target an expanded borrower profile. And, it's really important to see and for everyone to understand, to be competitive, you really do need to have these products in your toolkit because your borrowers need more options than just agency options. So I'm really excited about what's happening. I don't know who to flip it over to first. I'll throw to you, Robert, because you've got, a long history and that you go back before this chart started. But love to get your perspective on some of this rotation that's going on.
Now, you bring up a great point, and our history dates even before this chart, going back to '99, and as you shared, my experience has always been in, call it the non-traditional, non-QM, whatever you want to call it, in any market. So we existed, and when the market collapsed '07, '08, as I look here on the chart, we were operating in that small band, and what always fascinated me was kind of the myopic view that a lot of investors had. They looked at this non-traditional as kind of a pariah. They caused all this problem. That really wasn't the problem. It was bad fundamental products. 100% stated income is just flawed. It was, a recipe for disaster. Small segment of the population can do that. So for all those years, we existed in that little bandwidth. And when I met you guys, and coming in, it was a product that was needed, and what you guys have created has really been a champion for the non-QM space. So I think now, Wall Street is not necessarily innovators, they're followers, they're copycat, much like the mortgage industry. Everyone kind of sees what everyone else is doing. And now there's a trend that there should be a safe portion of mortgage lending in this non-traditional space. And non-QM, DSCR, bank statements, whatever in this space, it's a healthy mix, and that really creates a vibrant economy and access to home ownership that is there. The builders need to kind of pick up their pace, and that's where you hope that the benefit of lowering the borrowing costs with what the Fed actions are going to happen this year, what happened yesterday, and even for the remainder of the year, will make it more viable to bring additional inventory to the space. For the millennials, Gen Z, the younger folks coming up, we're going to need more housing. So we're in an exciting part of the marketplace that the graph doesn't lie, that we're going to see more. It shouldn't go back to the pre crisis 50%. I think you're spot on it. Around 30 to 35% is a healthy mix when you combine that with the GSEs and the conventional lenders out there. That really creates a dynamic market. So this is becoming much more well received by both the institutional as well as the originator. And we're talking to the originators out there, and how can they understand that there's still a big knowledge gap in the space with non-QM. And that's what doing these types of webinars will hopefully help those newer originators trying to learn it. And even some of the old veterans still don't fully understand the non-QM product because they've been so mired and focused on that conventional lending. So you're doing a great public service, Eloise.
Oh, that's our mission. Yes. But I'm going to flip it to, sort of the rate environment, because I think this is really important. And we've watched this yield curve. It's a very unusual yield curve, but we've had it for a while, this U-shaped yield curve. But you can see from July, August, and September, the entire U has been, dropping. We just updated it for rates as of yesterday. And there was a pretty good drop in the 30-year, even though it wasn't the full quarter, because some of it was already baked in. But Clint, as you think about rates in general, I guess I'm going to talk a little bit about the right side, and I'm going to let you talk about both market rates and then what's going on the right side of the page. But I think it's interesting when we think about what's going on the right side of the page. That is, the black line is the 30-year agency rate, and we updated this as of this morning as well. And we've got the gold line, which is the LoanNEX index for a fairly, down the middle credit box of all of our investors. So it's the aggregate rate of all of our investors on the platform for that. The green line is DSCR, same thing, it's a LoanNEX index. And the silvery blue line up on top is what we call our silver FOLDOC, which is just a little bit of an expanded credit box. And we watched DSCR and gold converge, meaning the pricing for those, the spreads were on top of each other. That has to do, I think, with prepayment penalties and overall demand from the market on that. But now we saw, starting in June, that actually start to trade inside um, the gold. And I guess that's, you know, the value of the prepay in a declining market, but that's in your world, Clint. So I was sort of curious, you know, a little bit of how do you see the demand for the DSCR products with interest rates and, you know, compared to other products?
I tell you, I think the bottom right corner of the right chart is one of the most telling things we're going to talk about on this call, and really the almost insatiable demand that's out there for the non-QM, non-agency product suite that the market is sort of producing at this point. You know, that's, and Eloise, correct me if I'm wrong, but that's the total 30-year fixed agency rate in black, right? And
Yep.
DSCR, gold, I mean, those are right on top of each other up until about, 10 days ago. That is by far the tightest that I think I've seen it in the last 3 or 4 years. And really just a testament to just an incredible amount of liquidity for those products out there, and really a finite amount of loans that exist. So you've got an ever increasing number of investors and insurance companies, securitizers, aggregators, whatever, all really competing for what feels like a smaller set of loans. So I think that's really what's driven that, that gap in between really that gold or the DSCR index there with the 30-year product.
Yeah, now do you think, because typically the agency rates will drop a little quicker than everybody else's rates, there's, a few days lag between them. And we're seeing right now, like, I'm sure that as I asked for this morning, maybe not everybody's rates were fully updated in so I'm curious, do you see the non-agency rates sort of
I think they'll
tightening
follow
quickly,
suit.
or be a
Yeah.
slow follower?
Look, it's very liquid, but it's not quite as liquid as, the TVA market. So I think they should follow suit. But again, with this kind of being the first cut in quite some time, I think the market will need to digest that for a couple of days before we see what will really happen with the non-agency rates.
Robert, do you have a different point of view?
No, I think Clint's on point there. Also keep in mind, in terms of investors. So here's a little education for, folks out there. The buyers, they have different options. They can buy treasuries, which is the baseline. They can get in and out of those, is kind of where everything kind of pegs to. And then you go up to mortgages. The folks that are buying non-QM, and that's where, as Clint touched on, the aggregators, the insurance companies, Wall Street firms, they want the delta. So it's never going to quite meet, although it's, the DSCR has gotten close because of the prepayment protection. So there's always going to be this spread between, the traditional 30-year and non-QM and DSCR, because they want a little inherent risk premium for that. So you're just going to see that. So that's why you're always going to have that gap between those, why it's going to be more expensive. So when your client says to you, well, but I see rates are 6.35, you're offering me 7.3 on this. Well, here's why. You're not a traditional customer. You're not the same. If I could take you, I would take you there. I have to take you there. I can't sell you a product that's more expensive, but you don't qualify because of your income, self-employed, whatever the reason for. So that's where you're going to be able to explain to them why they're paying a higher rate in the market, but they're getting access, and it really works in lockstep and creates a spread there. So keep that in mind when you're selling your customers.
Yep. All right, I'm going to flip to some of the activity that's going on in the market. So, Robert,
Eloise, before we go any further, I just wanted to
Okay.
get either Clint's or Robert's thoughts on, over the past couple of years, you've had a lot of insurance companies stepping in and looking to buy a lot of these assets and hold them on their balance sheets, compared to the securitization side of things. What are you seeing in terms of the balance of execution in the current marketplace between those two kind of strategies, as well as, are you also seeing some price competition between those two outlets? And is that further driving some of these rates downward?
Yeah, absolutely. I think you're seeing, some price competition between, whether it's aggregators, insurance companies, securitizers. I think 2024 for me, it feels like insurance companies were a little bit more active, but the securitization markets come back, wholeheartedly. So I think that, again, there's no shortage of demand on the insurance side, on the securitization side. So I just think that in one point on that, I think as an industry, we've done a pretty good job of staying somewhat balanced in terms of our overall credit. With all that demand, there's a temptation to really sort of blow out the credit box and start
Right.
making, those, 95 LTV or 90 or whatever they are, super low FICO loans. I think so far we've done a pretty good job of staying, you know, uh, within the guardrails there. So I hope we continue to do that as an industry because I think that, no, Robert's been through it, I've been through it. No one wants to see kind of the '05 through '08 stuff again. And the more that we can prove to all of the liquidity providers in the space that this is a really good place to deploy capital, the better off it's going to be for everyone on this call.
Yeah, it's a great point. You need to have a balance. You talk about, those dire days of, '08, but really you go back to 22 when, rates shot up. It closed a few companies because they were caught offside because of their strategy. So you really need, for me, for us, and this is a little higher level, you need to have a mix of both the whole loan, strategy as well as the securitization, and they both have their pros and cons. There's no perfect, loan sale execution for us. Although I keep looking for it and hoping that we'll find it. You need to have a few dance partners in the capital markets arena to make sure that you've got a broad enough, offering and execution, but you're not beholden because the folks that were just pure securitizers got killed in 22. I mean, that was
Yeah.
an awful time. So you got to kind of balance those between those. And I think Clint, you're on point when you say that, the competition does drive, because the insurance companies need the loans, they need the assets as well as securitizers. So it's good having a little healthy competition to fight over our loans.
And hopefully that was similar to the, 100-year flood, a once in a lifetime kind of event where the rate shock is what created that dry up in the securitization market. So that was an incredibly unusual experience and really, had an enormous ripple effect on liquidity. But anyway, so I'm going to switch this to some of the stats that are going on. Robert, do you want to talk about sort of trends that we're seeing, at least across the LoanNEX platform?
Yeah, I
we've
mean,
definitely-
oh,
Which Robert are we
Oh,
talking?
sorry, Robert T. Robert T.
I was like, okay, I'll make it up.
All right,
I don't
I'll
know.
jump in.
I don't know. Sure.
Oh, you're a big user of ours there, Robert. So you're probably driving a good amount of this production coming through. But you can see the actual loan scenarios or loans that are going through the platform those are continuing to rise. The percentage of the loans met is still holding at north of a 90%, which means the knowledge base of the originators out there is improving and then the eligibility rules that have been programmed in the hard and soft guidelines continue to vet these loans through and hopefully make a better end product once it hits the manufacturing line of the fulfillment centers. We are still seeing DSCRs being a key driver on the investment side, and I think Robert and Clint, you could probably attest to it. That with the strong credit profile of these business purpose only borrowers or investors, coupled with the call provision, the prepayment protection that's out there, you have a lot of demand, and hence on the prior side you see a lot of that kind of tightening between the DSCR production and coupons to the 30-year. Now, As Eloise likes to say, we're always over-indexed when it comes to our DSCR production or what's coming through our system, or stats-wise at least, just because it is handled so well or elegantly within our platform. There's also, there is some risk, and we talked about it in our prep call about on the DSCR. There's been we had a little blip over the last few months due to some bad actors in the space, and I'd like to ask both of you, how are you looking to mitigate that, or might want to explain what has occurred? I know, Clint, this was on your radar very very prominently, and if you can expound on how that came into being and what you've been doing to mitigate that, and Robert, if you can follow suit with what you're also doing in terms of your better practices internally to make sure that you can catch these bad actors during your origination processes.
Yeah, sure. So certainly, I would imagine most folks on the call have read about this, alleged, whether it's, I'm not going to say fraud scheme or whatever it is. There's some questionable valuations, happening in the market, it seems like, and whether or not that is, I just think it's really important for us. I know we're taking a second look at almost all of our appraisals that come through as a loan buyer, and really trying to get comfortable with those values, because I think, again, most of the time with these non-QM, non-agency products, they're designed to have the borrower have some skin in the game, whether that's 20, 25, 30% equity. And I think as long as you get that right at origination, I think the loans have a much higher likelihood of performing. If you happen to get that valuation incorrect and there's really, no skin in the game or not as much equity in the property, I think you're a little bit more exposed there. So we're just heavily focused on making sure that that the values that, are being presented are accurate, have good comps. So really just trying to nail that valuation process is where we're, hyper focused at the moment.
Well, following up with that, not to put a negative, because we want this to be positive, but for the originators out there, you want to put good products forward. You want to have your name attached to good loans, and it's kind of the common sense sniff test. And DSCR to me is a concern in the marketplace because it opens up a path to a lot of questionable practices. It could be a occupancy fraud, and or in the case of the systemic problem that happened where this investor defrauded, set up this kind of shell operation that I've heard upwards of $250 million in originations that were spread around a bunch of different investors that really were manipulated with it. And this is an old story that's happened in my 30+ year career in different pockets, where you have an alignment with an appraiser and an originator, investor. So it happens. So you just want to, for us, we're going to question, look at the appraisal. We're going to get, the data is out there. I mean, as simple as Zillow, as simple as CDAs, SSR reports, and, kind of common sense of looking at that. So it's better to ask for an exception than to try to manipulate something as an originator. Just ask, shine a spotlight on and say, hey, here's what I'm trying to accomplish. How can I best get there? And that's, I'll say that a lot more often, is we provide the solution. So for the originators, do that. We're going to do the diligence behind the scenes, and, and make sure that we're aligning with that value. And if we have questions, maybe we'll get another appraisal, to feel comfortable. No lender goes into it wanting to turn down loans. We only get paid when we make the loans and close the loans.
Exactly
So
right.
that's how we make money.
I was gonna say, and I really appreciate both your comments, but what's super important and different than the historical markets is the products have really evolved. The partnerships have evolved. The ability to find sophisticated or common sense solutions has evolved. So I appreciate you saying ask for the exception or shine a light on it, because everybody's there to find a solution. And if it doesn't, the square peg doesn't fit in the round hole, don't try to force it or try to fake it. Just, work with your partners. Your partners are there to find a solution. I would say LoanNEX is the same way. We give a lot of insights into everybody's programs so that you can find your way, how to navigate your particular borrower's situation. But your partners are always there, whether it's by email, phone call, whatever it is. Those are really important takeaways, I think, because there's an enormous amount of demand, but getting it right is best for everybody: the borrower, the originator, the investor, everybody. So
Yeah.
Let me add to that as advice again for the originators out there. More information is better. Again, we're going to find out. We had a situation, we found a great solution where this borrower didn't have quite 2 years of self-employment. We had products. They didn't want to go for our 1 year. But what they didn't tell us is in the middle of their 18, 20 months, they had 6 months off. We were able to find a solution with their spouse. They had enough income to solve that. They missed that little detail to share up front, where we found that, on the back end, but there was a little bit of heartburn, from the AE trying to find a solution. So we dug into it. I got on a call with them and we found that solution for them. But more information is better. Don't hide from it. Shine a spotlight on it. Bring it forward so that they can see it, hear it, and figure out and know what they're getting into, so they can either get to a quick yes, or sometimes even a quick no is a benefit, because you don't want to drag it and waste their time and or your time, as the originator.
I wanted to pull out a couple of their stats in here, and that is, the alt doc side of this. And so it's so conveniently listed in here as other, because there's, P&L, there's asset, there's a lot of other pieces in addition to the bank statement loans. But we are seeing that on the rise. And that's because I think they're not only from a demand, it's sometimes an easier underwrite to work through a P&L, but people are now evolving some of these alt doc programs to include bank statement with it. So there's sort of a little bit of a hybrid on some of these, so that there's an easier underwrite, but also it's still, not going all the way to just like a, potentially stated income kind of loan. So I don't know, Robert S., if you guys are seeing some of those program evolutions, or you want to talk through some of that sort of self-employment alt doc side of the market.
We love those. Robert T touched on it earlier, with mitigation, with, skin in the game. So, there's a lot of different ways to get to the ability to repay. And, where the non-QM industry has evolved from bank statements, now we have these P&L options, and within that, looking at some of the historical, what you find, what hurts bank statements, if you have kind of this fluctuating up and down, not consistent income, but they have the income over the course of 12 or 24 months, but it doesn't quite fit the bank statement box, then you flip it to the P&L. And those can range anywhere from 20 to 30% down for the purchase money, is a really good option for those borrowers, those self-employed borrowers that may have some, fluctuations in their income that doesn't quite work for that. So we do a lot of that. But again, looking at the common sense, and you want to put people in a position of success. That's again kind of the moral quandary, and the law states we want to make sure people have the ability to repay. So, doing that and making sure we document that and getting that information, that's kind of the fun part of it. That's why I enjoy this. So we can find those solutions for the borrowers, and we do that all the time. So that's a big percentage of our business.
We have a question from the audience here, Eloise, that might be germane. What is the expected IRR on non-QM loans? Any differences between DSCR and non-DSCR? And I think that comes more from the origination side. Robert, you want to talk to that?
Yeah, I mean that's kind of technical. So, you want the DSCR is a little bit of, I don't know, I would say, they investors like that product, so they offer a little better rate, as you could see from that one chart that we put up, because there's a prepayment protection of 3 to 5 years typically on those. So investors, they want stability, so they know that that will perform. The IRR, what the expected, it changes from day to day. So loans that are originated today, closed today, won't be in a securitization for another probably 90 days. So there's some anticipation of that. So in a declining rate environment, securitizations do really well because what's originated today, in theory, will be more valuable down the road, but it also runs a risk of the prepay if things get too
Right.
much that they're going to run off in 6 to 12 months time. So, I don't worry about so much that from a execution. That's really more for the capital markets teams to focus on because it's a guessing game. And like any economists, they're smart looking backwards. They're not as smart projecting into the future. But you kind of look at where things are today, and you kind of look more 90 days into the future. So it's a constant moving target, and you can have one instance, a geopolitical event that can spike things up where you think everything's are going. So it's nothing works in a straight line for sure. So I don't think we answered the question, but it's really not a
think you did
specific
great.
answer.
Yeah, I mean, look, there's no way I could give an exact number. I'll tell you, for us, we're largely a portfolio buyer at this point. So really, these loans are really an offset to the insurance company assets and their policies that are written over there. So, we certainly evaluate securitization. And I think was it Robert T earlier that mentioned, or Robert Senko that said, these loans should have a slightly higher coupon than your run-of-the-mill plain vanilla GSE loans. And what is that spread wide enough to justify putting those on our balance sheet or in securitization is really the math that everyone's trying to do, and then trying to figure out what the expected losses are. And on the prepay penalty, how much does that slow down the prepayment speeds on these loans? Does it make them stick around longer if rates go down really fast or rates stay the same? So certainly a very good question, but the answer is a lot. It's pretty complicated one that I certainly don't have all the answers to. So
I'm going to switch gears for a second. And Clint, I know that when we sort of had our prep call, we were talking a lot about some of the cash out trends and so forth. So what we've just got up, is really, just the split of what the purchase activity is and then what the refi activity is. And a lot of that, I'm just going to flip up here for 1 second. The cash out portion, while as a percentage of the mix came down, it still is a larger number, but the rates are what drove those rate term refis. But if you want to talk about, how you see the refi market, especially since we're in a declining rate environment, and what's driving that on predominantly the DSCR side of things.
yeah, well, I think the DSCR product, and by its very nature, is going to be always going to be a very cash out centric product. Investors like to put some sweat equity into the properties, draw some of that capital out, and in theory deploy that for perhaps their next project. Just in terms of what we're seeing in the market, we expect cash outs to perform worse than purchase. That's, I think, pretty much everyone does. We have seen some, maybe some blips in terms of how rate terms perform recently in some of the more recent vintages. And to us, that's, it's hard to exactly nail that down, but, one potential answer could be, what sort of borrower is doing a rate term refinance in a 7.5%, into a 7.5% loan. It feels like that could be the loan of last resort, or they're staring down a maturity default on a bridge loan or fix and flip or a failed fix and flip. Certainly it could have been the plan the entire time to refi into a term DSCR loan. But that's just one hypothesis or one thing we're taking a look at. We've actually started to price rate and term differently than how we price purchase for the first time in quite some time, perhaps ever for us. So I think that's something we're keeping our eye on. But obviously now with rates starting to come down, hopefully that will allow some borrowers or perhaps originated in the last couple of years that didn't have a large prepayment penalty to potentially take some more cash out.
Yeah. I mean, certainly tapping that equity has been a really important part. And as rates come down, it might be a little less important because there might be a full refi opportunity to not just either the seconds and that cash out are both, ways we're seeing people tap into their equity. But rolling that equity on investment properties is a lot of the motivation on the cash outs. I wanted to get your thoughts, and we talked a little bit about this on the pre-call too. Robert S., I'll start with you. Get your thought, for people that are looking to grow this side of their business. They may be working all in wholesale and now looking at maybe doing non-del, or they're just starting it in their organization. As you've worked in this industry for a long time, what are some good tips for them to, grow and be comfortable growing this part of the business?
That's a big question. I think that's the challenge that a lot of folks, both originators, branch managers, owners of IMBs, really contemplate in, how they can be competitive in the market. I'll back into it from an originator standpoint of, you go to a cocktail party and you're trying to network and, sell yourself. What I hated about, your traditional lending, people, oh, you're in the mortgage industry. What's your rate? You were only defined by your rate. And to me, that's boring, and that doesn't value the person that you are and what you bring to the table. What you sell, what I promote, and what I've grown my career when I was less gray is, selling solutions. And that's where I've tried to build that into ACC, and we'll see that in a future slide. So when you talk to someone like, well, tell me what problem you're having, whether you're talking to a real estate agent, oh, I've got this person, they're wealthy, but they just started a new business. My bank that normally does it can't do it. You're going to find the solution and you're going to be the hero to them. Same thing for your branch managers. Your branch managers want to support their loan officers and they want to bring more tools and make them effective so that they can go out and promote. So bringing that to them, for the IMBs that are looking to grow and create another income stream. Well, now you need that non-del. You want to be able to, you have the balance sheet, you have the warehouse lines, the way you operate, they want to be more competitive with all the clients. So that's where but they don't have the underwriters, in-house that can do it like their, their FHA underwriters, conventional underwriters, and those type of tools. So that's where they evolve, and everybody's evolving. We're evolving as a company, evolving as a person. So that's where you look to grow and bring in. And when you choose partners that are well backed and historical, like ACC and Clint's organization, where they can, bring that value and that stability, that's what you're looking to do. Because every business, if you're not growing, you're dying. Isn't that like some meme or T-shirt that, that's what you look to do and build yourself, whether it's an individual or building your organization.
And I will say, from that perspective as well, what we hear time and time and time again, if you don't have these products, you're going to have a hard time getting and retaining good people, because this is a really, really important part of the market. We're watching people start to add these products to their portfolio. They may not be comfortable, but if you look across these top boxes, you've got number one is to really partner with your investor. And I appreciate that I've got two great clients on the call, but I'm going to say this is universal. I know you guys are great partners for your clients, but lean into that. That's what they're there for, is really to help you be a problem solver, help you be successful. And I'm just going to say, of course, leverage your technology. That's us. But these are really, great ways to be comfortable and be confident in selling these products. I don't want to get out of time without giving you guys a chance to talk through your products and programs. And Clint, I'm going to start with you. Sorry, if I can get my cursor right. If you want to give us a overview of Silver Hill's products and programs.
Sure. So Silver Hill Capital, just for everyone on the call, is recently rebranded. It was it's a Bayview Asset Management owned company, but Silver Hill is really focused on acquiring non-agency whole loans, primarily for our insurance company balance sheets. And that's in a number of different products, whether it's bank statement, DSCR, agency non-owner occupied loans that we balance sheet as well. And we acquire those on a whole loan basis through both delegated and non-delegated correspondent relationships.
And I'm going to have everybody's contact information in this presentation. So when you get it, it's all clickable and you can find out more information about Silver Hill directly from the platform. So Robert, you want to talk about ACC?
So, it's interesting. I forgot about the name change, Clint. So years ago, and I'm going back 20 years ago, I used to sell loans to Bayview. So when I was kind of a baby banker, is what I would call myself. Going back to the question of evolving, I was selling, small pools to Bayview back in the early 2000s. So, how you grow and how you evolve, like, what you're doing today isn't what you should be doing tomorrow. You should be looking to grow. So I forgot that piece. So I wanted to highlight that because Bayview was a great partner to me many, 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 many years ago. But where we've grown is, we've gone to, our Fab Five products. And, these are kind of universal, but we try to distill things down to its most simple, basic formula so that it's digestible in terms of, prime loans, prime plus, which includes a lot of ITIN product, which is obviously there's a lot of political conversations around that, but I still believe that it's a very viable and important product in the marketplace. DSCR, we spent a lot of time on, is a great product. Second Chance, which is really how this modern iteration of non-QM came about, coming out of the great financial crisis, was a lack of liquidity. And that original kind of chart that Eloise shared, there wasn't that much outside of the GSEs. So when people started seeing opportunities like ourselves, when we were just a portfolio lender back in those tough days of 2010, 11, 12, 13, 14, lenders started coming in for those second chance. People had their, short sales and deed and lose, and there was a lot of turmoil in the housing market, but people got themselves right again. So everybody deserves a second chance. And again, you mitigate that risk with the skin in the game. People were putting down 20 and 30% into those. It's kind of hard to, get hurt when, there's the ability to repay and then there's the willingness to repay. And when people are putting hard-earned dollars into a deal, they're going to fight to keep that because they've put in a big chunk of money. I think in one slide, Eloise, he added about $500,000 was your average loan. So if someone's putting down, 20%, that's at least $100,000, if not more, plus closing costs. So people aren't going to just walk away from that like people did under the 100%, stated income days, which should never come back. And then closing seconds, there's a ton of equity sitting out there. People are sitting on low rates. They're not going to come back down to that 3% range. I hope they don't, because that means we're having some tougher economic times. But people want to tap into that equity, whether it's rehab, whether it's, college, debt consolidation. So, having all these products in your mix, your tools, and like we said, selling the solutions and having that is really what defines and makes you either a better loan officer, branch manager, mortgage IMB, wholesale lender, having, that the widest breadth of products to be able to offer is going to make you, competitive and grow and evolve and scale your operation. Again, you got to grow and evolve, every day to be better. And, these products help you be more competitive to, your earlier point, Eloise. So that's what we've done. And, I think about it from that perspective.
Well,
If you want to jump in here real quick, if you want to meet everyone here on the at least the companies that are on the webinar today, we have the upcoming MBA annual in Las Vegas. I assume Clint and Robert, your companies will be represented there.
We will.
All
And
right,
I should have mentioned, Robert, also how important LoanNEX is as a partner to us. They've been fantastic to work with, and I think no one does it better than they do.
well, I certainly appreciate that. And we've got, some pretty exciting new things that we've done on the platform. One of which is a full, integration in the Encompass environment for retail originators. And what we're able to do is sort of tuck in alongside your existing workflows. So for those clients that you've got a very well established workflow for your agency paper and it just doesn't work so well for the non-agency, don't sweat it. Just add LoanNEX right in, and you're going to get all the benefits of LoanNEX with a really streamlined lock process. And if you take anything from this webinar, I hope that you take the most important parts are this part of the market is growing. You should be in a position to serve as much of the market as you can. It does not have to be intimidating. You've got great partners, both with your lenders and investors that you're working with, but also with your technology, and lean on it, lean into it, and really, I love how Robert was saying, be a problem solver, deliver solutions. But you don't have to do that. Doesn't have to be intimidating. It can really be a very easy, seamless process. So thank you, Robert T, for mentioning the MBA. We're all going to be out there. There's a lot of exciting things to talk about. Please reach out. Like I said, this deck is going to be available to everybody. You can have everybody's contact information, get more information about these companies, how to meet with us, how to learn more. But I want to say thank you to Robert Senko and Clint Thomas so much for being on this presentation with us. We really appreciate all your insights.